Street, puddles underneath our feet.
All right, hello everybody. Welcome to our speaker event today. This is a collaboration between Lynbrook Economics and Monta Vista Deca. So without further ado, let's get started. So just some quick norms. This event will last around 45 minutes to 60 minutes long, and there will be a Q&A session at the end. Please ask questions by sending a private message to me, Cindy Chow, not to the speaker, and feel free to send them anytime during the event. Also, please stay muted while the speaker is talking and turn on your cameras if possible, and listen and be respectful. Right, so today we have Professor Orlando here with us. He is the Adjunct Professor of Entrepreneurship at the University of Southern California and teaches growth hacking. He also runs the USC Marshall Incubator program for businesses founded by USC students, alumni, and faculty. Professor Orlando has led startup accelerators on 3 continents and was also a hackathon winner at the TechCrunch Disrupt Hackathon. So without further ado, I'm going to hand the floor over to Professor Orlando.
Thanks, Cindy. Hi, everybody. If you like, turn on your video. It'll, make me feel more like we're having a discussion here, but up to you. Thanks for that introduction. I'll just say one little correction is in the last word. I wasn't in a band at TechCrunch Disrupt. I have been in a band before, but that was a hackathon at a big tech conference that started to change the way I think about a lot of the questions we're going to talk about today. So, okay, I see some cameras coming on. So yeah, feel free to, if you like, it'll help me also just kind of get a read for, am I speaking too fast or too slow? So really good to be with you. I'm going to share some of what I teach at USC and also the way I work with startups. And like Cindy said, I've led 3 different startup accelerator programs. And if you're not familiar with this concept, it basically means we look for a cohort, like a group of usually pretty early stage startups, so founders who are building something. And we feel that there's a way that we can help speed up their development, help speed up their access to customers, to follow on investment, a lot of that guidance. And it's partly a process, it's partly a community that kind of grows, but I've done this in a few different locations. So why don't I just start to share my screen and I'll talk through some of these topics with some visuals too. Okay. Do you see my screen? All right.
Yep, you're good.
Okay, good. So, all right. So this is just like quickly about me. So I had a startup in New York for a couple of years and made a ton of mistakes. I started getting interested in just how other founders figure things out or often don't figure things out. And part of that exploration for me was taking my experience and then starting a startup bootcamp and then doing these 3 different startup accelerators. So I started Hong Kong's first accelerator program, which was focused on hybrid HTML5, mobile app development. I got invited in to lead a program in Rome that was very unusual. It was actually partnered with the Vatican for social impact, insight into deploying climate change related technologies around the world. And since 2014, I've been at University of Southern California. So I do two things there. I run the University Incubator program, and we've had about 140 companies come through. And I also teach. And one of the classes I teach is a class in growth hacking that I created after I was hired. And this last year, when everything went virtual, I needed a different format for teaching. I used to do almost 100% of the instruction by bringing people in to the class, first of all, like other entrepreneurs, and we would kind of interview them. But I would also do a ton just on the board, and we would like derive some formulas live in the class. And that got a little more difficult when it was virtual. So as a result, I ended up putting this book together called Growth Units, and it's a book on lifetime value and customer acquisition cost. So to introduce these topics, I'm actually just going to show you a picture from an event that I know you were not at, because it is, years before, well, any of us, including me, any of us were born. But this is a still image from a 1970 game in the World Cup, Brazil versus Peru. And the big arrow there is pointing to, one of the most famous soccer players of all time, even today, still very famous, Pelé from Brazil. And there was, at the time, a sneaker war happening. So primarily between Puma and Adidas. So these two sneaker companies were going out and trying to get athlete endorsements. And they wanted to, in other words, build their brands up. This is relatively early in the history of those two companies, but they wanted to build up their brand. And a way to do that was to get some famous athlete to wear your shoes and, be in an advertisement, be on TV. And Puma and Adidas actually had this secret pact. They called it the Pelé Pact, where they knew if both of them went after Pelé, the most famous soccer player in the world at the time, they knew they would just get into this price war and it would be bad for both companies. So they agreed that they're not going to approach him with an offer to represent one company or the other. And Pelé did not know this, and he was actually upset. How come nobody is coming to me? All my teammates have deals, and I'm the star. How come I don't have a deal? And what this picture represents is when that secret pact broke down, and eventually a representative from Puma talked to Pelé without permission, from their CEO. They got a deal, and the deal was this: it's not a traditional formal ad. Pelé is not going to be in a commercial on TV. He's not going to be on a billboard, anything like that. All he's going to do is, before this game starts, he's going to say, "Oh, stop, hold that, don't start yet." And he's going to bend down and tie his shoes. And the cameras are going to zoom in. So maybe the first thing, before I talk too much more, I'm just curious, like, anybody have a reaction to this this tactic? This is the campaign right here. This is the ad. Anybody have a reaction to, do you think this is a good idea, a bad idea? Anything that you want to share? The way this history is hitting you.
I personally think it's pretty interesting, since I would wonder when he's tying his shoes, how would people be able to see his shoes, even people in the stands, it's so tiny. It feels like a really strange way to advertise. And yeah.
So you're right. People in the stands certainly couldn't see what the shoes were. However, the commentators, and this is not a great picture, but being able to zoom in to the point that you can see, oh, he's wearing Pumas, not Adidas or not some other brand, and it's a casual, seems like off the cuff comment. Doesn't seem like an advertisement, right? So, we're in this world now, we have been for a number of years, where a lot of the ways that companies try to influence us, it doesn't necessarily seem, maybe to the uneducated observer, casual observer, it doesn't maybe seem like, oh, I'm being advertised to, or you're trying to influence me to buy this or that, but that's often the case. And, this was, I'll say, a successful ad, $120,000 that was well spent. Probably, got consumer behavior in a way that had they spent the exact same budget on, at the time, TV commercials or billboards or any of those like kind of legacy ways of reaching customers, it's like what everybody else is doing. This though is going to be a little different, and there's going to be maybe a little buzz on, oh, do you see that? Yeah, he's wearing Pumas. Haley's wearing Pumas. And it's at the most crucial moment, like the game is just about to start. So let's take this idea and let's start to introduce two concepts: lifetime value and customer acquisition cost. And these are the straightforward definitions of the two. Lifetime value is a prediction of what you're going to earn over the lifetime of your relationship with the customer. So you might have businesses where, there's one interaction. They sell something once, nobody comes back. There's businesses like that. There's also businesses, commonly today, like SaaS businesses, like subscription related businesses, where I'm charging the customer every single month or every year. And I'm expecting I'm going to keep a relationship with those customers for years and years. Where if I haven't, then something is not right in what I'm doing. Customer acquisition cost. So sometimes we can acquire customers for nothing, as in it's word of mouth. I tell somebody else, oh, hey, check this thing out. And then they actually buy, they become a customer. Often though, there's some cost to that. So that might be a cost of advertising. It might be a cost like of doing like a paid social media campaign. There might be influencer marketing, right? A lot of ways that we could do paid campaigns today. But these two concepts form the core of unit economics, form the core of how businesses think about growth per customer. Growth per customer. How much am I earning per customer over that relationship? How much does it cost me to acquire a customer? So let's look at a little case study. And this is a company that launched in 2015. 2015 was the year that a lot of food delivery businesses popped up. There was a lot of funding going into companies of this type. There's a company called Bento. And so they raised 1.5 million in 2015. At the time, I'll say that was a good amount of money. These days, it's not such a big deal because things have changed a lot. But this company started in San Francisco, and I think they moved to the East Bay for doing deliveries. And I'm going to show you an actual chart that this company presented. And I've, since there's a microphone in front of some of the words, I've helped with, typing in the words that are, covered. But take a look at this. So we have a number of things in this chart. So we know the date. So this is right, when this article has been, like a month after that article was written. And we know things like, okay, how much am I charging customers? On average, $11. I have all these other things, the coupons, the packaging, the food, delivery, cooks, waste, and then I get this total margin per bento at the bottom. Negative $19.55. Any reactions to what you've seen so far? Anybody think, oh, good, bad? I see Ethan with some kind of a reaction, there, a surprised reaction. Yeah, like, what do you think? If this were your company, do you think, things are going well? Things are not going well? What do you think?
I think the numbers look really scary, but then for a company in like its startup phase, it seems somewhat reasonable.
So that's a great point. Okay, doesn't look great. You're losing money on every customer, but you just started. I can't expect that you're going to be immediately profitable. All right, here's the follow-up question. Which of these different areas do you think they could improve on? Say first, what's likely? I see things in the chat. I'm not sure if Cindy, you want me to read. So, okay, so people are saying waste. So that's a good one, and I'm not sure why there's a lot of waste. Maybe because they're just buying too much and they don't have a ton of customers right now. So maybe they just need to like figure out how to purchase more efficiently. Why do you think delivery is so high? Like, gee, like $8 to deliver something to just one person. Like, why do you think that's so high? It's like almost half of my my loss here. Any ideas? Might be doing one drive per delivery, says Siddharth. Yeah, I mean, I think it's probably that. And then Ian says delivery is cheaper with scale. I think you're right. When you're a really small, company, like do a thought experiment. Okay, we have one customer. We exist. We have customers, but just one. So every time that one customer puts in an order, I need to well, okay, let's get the car that I'm like, renting, and like drive across town, deliver the one thing, drive all the way back, like not efficient at all, right? But I should expect things improve over time. Let's see how they actually did improve, because I have that as well. So that was July 2015. Now, was this 15 months later? Things have improved a lot. Wow. Okay, so I lowered the price. I stopped doing coupons. I'm much more efficient with packaging. Better with food. Wow, delivery and logistics is like nothing, almost. Cooks, I'm better with that. Also, probably because I have more scale. Wow, zero waste. Maybe zero waste scares me a little bit. Like, maybe I want to see a little waste. Like, maybe I don't want to see like, oh, you're using every single thing. But wow, a lot better. Even charging less. Now, at least I'm making some money per sale. What a difference. Wow, we turned the company around. We did it. We succeeded. It's a win. So what do you think happened with this business? Do you think they went on and, I guess you might have heard of it. You're in a similar area to where they had launched. Do you think they went on and, they're now a massive company, or they did something else, or what?
I think just like looking at the data we're given, like they would go on, since like just in 1 year they were able to improve so much. Like in the next couple of years they might like improve even more with the cost.
Reasonable expectation, Cindy. But actually instead, just a couple months later, they shut down. And the problem here was, they did figure out their unit economics. They have now a positive, even if there's only one sale, they have a positive lifetime value per customer, right? But, what did they raise? 1.5 million. And in a year and a half with a team of people, and especially when for the first, whatever it was, year, you're losing money on every single customer, you can blow through 100, you can blow through 1.5 million pretty fast. They ran out of time. They learned too slowly. So these things did not change, right? The way a business operates this is like just math, but they learned too slowly and they had to shut down. So let's do some quick, questions here. I have two businesses, two different LTVs. Which one should I focus on growing? You can, again, put it in the chat or call it out, whatever you like. Not sure if your speakers usually do this much like back and forth, but you'll have to forgive me if you didn't expect this. Anybody want to vote for one or the other? Okay, we got to vote for one. Business one. Anybody want to vote for business two? Okay, Cindy's voting for business two. All right. So it's interesting. So like, just on what we have now, which is not everything, looks like this business two is a lot better. I mean, the LTV is a lot higher. But a lot of things I don't know, right? What if business one, I can acquire customers really cheaply. So if I want to see what's the ratio between acquiring a customer and what the value is that I get from that customer, is like, wow, that's pretty good. And if business two, yeah, I'm making more per customer, but I'm also spending a lot more to get a customer in the door. Now, all of a sudden, business one might look better. But really, there's all these other things that could also happen. I might say, hey, I can improve my efficiency just like Bento. I can, improve this LTV a lot. I can cut costs significantly. Or I might say, well, you know what? I can't really do anything about the costs. It's still going to stay like a $5 difference between LTV and CAC, but there's millions of customers here and there's only like thousands over here. Or what if it takes me years to get LTV in this one, and I can get this one in days? All these questions. The simple formulas for LTV and CAC, I sometimes call this the static formula. If you read growth units, or if you're in my class, I'll call this like the static formula, because it just gives you a single snapshot. Instead of presenting the information as a series of flows, like what happens over the months that the business is around, you're looking at a few things to calculate LTV. So customer lifespan, that's like how many times people buy once and you're out, or you buy every single day or every month or once a year, and on and on. And then how much are you spending and what are the costs of serving you? And we had like an example with the bento box company. The customer acquisition cost formula, also doing this as a snapshot, like a static, give you one number, is how much does it cost me to get somebody to visit? Visit might mean they go to my website and they see what they can buy. Visit might mean that they walk in the door of a physical shop. And then what's the conversion rate? So once you're there, how many or what percent of people buy after they are there? And then we have some rule of thumb, that we often use as a ratio between these two. We often say that in general, a ratio of 1:3 or 1:4 is good between CAC and LTV. In other words, LTV is not telling me everything about my costs. Like it's per unit. So it's not including things like rent or other fixed costs. There's other costs that I have. So I have this kind of, this buffer. It's also not telling me in this number, well, do I get this in a month, in a year, in 10 years, right? So these are rule of thumb, kind of numbers. 1 to 3, 1 to 4 is pretty good. But it can also be misleading, because what if it takes years? Hey, I've got this great 1 to 3 or 1 to 4 ratio, but I have to wait 5 years until I earn the money back. Maybe I've gone out of business already. I can't grow at all. Or what if I have some customers that are good, but many of them are terrible? Many of them, I'm not earning all that much money. The costs are worse than these, and they disappear. So they cost me money up front to acquire them, and then I never make the money back. It's negative, like it was with Bento. So there's a lot of things that we can do to try to understand what's happening in these businesses. I'm not going to go through all the details, but as a way of starting to talk about this, you can break customer acquisition cost out by channel. So that's the way that you acquire customers. Is it TikTok, Snap, Facebook, Instagram? Is it influencer marketing? Is it mailing lists? Is it print? Is it other more traditional ways of marketing to acquire customers? And you could do the same thing with lifetime value. You can break it out by customer segment. Well, I have lifetime value of the premium users and of the basic users. I have lifetime value of a certain demographic. I have lifetime value of what you'll often see SaaS businesses do. I have the lifetime value of students, and I give them a lower rate because I think they're gonna stay with me for years, and after they graduate, they'll pay the higher rate. Right? I have the student rate, I have the working professional rate. And that's why averages can also be dangerous. Like if you just talk about an average and you say, oh, what's your customer acquisition cost? You say, oh, $30. I don't really know that, wow, you actually can acquire customers for nothing in this third channel. Is there a way to grow that? Or is there a way to improve? Maybe it doesn't have to be so high. It's $50. And then once you add, say you're adding a salesperson who goes out and closes some of these, customers, totally changes, what your average might be. I'm going to skip ahead a little bit because I know in interest of time. Here, let's, as one last thing, and then we could do maybe more questions. So I went and I looked at the annual reports from Shopify, which is, I don't know, anybody use Shopify, but it's a way to quickly set up an e-commerce website. Lots of different plugins, you don't need to write a single line of code. You basically could start selling something, immediately. And if you look at their annual reports, they're a public company, they report what are they billing per cohort. The way they do a cohort is, people that joined in a certain year. So if you look at this chart, could you tell me what 2005 would be? What total billings would be? Anybody want to make a guess? And again, you can type a yes in the chat. Let's see. 500 million, 200 million. All right. So I'll say one thing that we have in common is, it's going to be bigger. How much bigger is the question? And I'll say in something like this is a business that's pretty predictable. And this is the basis of a SaaS business, predictability, right? And I could look, I say, early on, this pre-2012 cohort, that's really early in the history of Shopify. Their cohort from pre-2012, it's not that great. It kind of declines over time. At best, it stays flat. 2012 though, that's, they're billing more in that cohort in the next year, but then it's kind of flat. 2013, I wonder if the same thing's going to happen. That'll be kind of flat. Maybe this, maybe I'm improving the product, so this will kind of grow. I can pretty accurately start to predict what my customers are going to do in the future. I have enough of a history. I have enough customers to start to do this. And somebody had said 200 million. So that was a good guess. It was 200 million. And I could keep doing this. I could say, wow, they doubled again. And I'm looking at, okay, what's the pattern? Well, all right. Yeah, there is a bit of this predictability. Like isn't it just exponential? No, I'm going to say it's not, because, oh, this is a direct message to me. So I had a question that said, isn't it just exponential? No. The reason I say no is that, it is doubling per period. So you say, well, that's a sign that, that's the growth is going, up like this eventually, right? But what I'm really interested in, though, is what's the source of that growth? It's that a business like this gets better as people stick with it. And there's something that happens here, which I'm just going to go ahead, and they keep doing this. There's something that happens here that is a little different than other businesses. Other businesses, we're used to seeing people leave over time, to churn away over time. Right? That's a normal thing. I get 100 customers. Next month, only 90 show up. The month after that, only 80 show up, and on and on. There's something that we call negative churn, which does not mean that, well, I had 100 customers and then, 10 of them split themselves into two, they clone themselves, and now I have 110. It's not that. It's that I still might only have 90 customers at the end of that month, but the 90 that remain are spending more with me. And if I have that company like Shopify or any other SaaS business that, has enough predictability, I can start to predict what people are going to do. You are probably like these other 10 million people who joined at a similar time, doing a similar kind of business. You're going to start to pay me at this rate. And while in their case, they did see exponential growth, I'm actually interested in what the source of that growth was. There's a difference between growth and scaling. We use these words often interchangeably. Growing is about getting bigger in some way. Scaling, though, is there's efficiency there. So if you think back to the bento example, that was not a company that was doing very well in the beginning. However, they were able to scale to a certain point. In other words, they got efficient at delivering not one box a day, but 1,000 boxes. Now they can be efficient with their, delivery people and their trucks and their cooks. You will see different ways that companies are efficient at scale. Some businesses cannot scale at all. They can grow, but their costs increase more or less linearly as they add customers. Other companies, especially ones that are entirely digital, can, they can scale. They can become more efficient. I'm going to skip ahead again. I'm just going to show one last thing. So this is a chart that I made when I was looking at data storage companies in the past. And so you could think of a data storage company like Dropbox. You could also think of it like, any of the free email services, say Gmail. When these companies in general started, the unit economics per customer was different. They were losing money per customer. I'm giving free storage space. You're able to use this, and I'm not charging you. And I'm losing money. And this seems to make no sense at all. But a business that knows, in my industry, there is some predictability. I know the cost of storage space is declining in a relatively predictable way, which is true. And so the beginning of this chart is like 2004, Gmail launches, Dropbox starts in like 2008. Back at this time, I'm losing money per person, but I know as long as I can last, things are going to improve. The cost is going down, and I'm eventually, like Gmail, I'm adding ads, here. I'm adding, the unlimited storage, option. But there's this crossover, and eventually I get to the point where, you know what? Because I've built something that is a product that retains users, as long as I can get to that point where the costs per user are low enough for it to make sense, and I also now have a way of charging people. Like, you're not going to change what email you use all the time. You're not going to like stop using Dropbox and start using Box or some other file storing thing all the time. There's a bit of lock-in for the customers that you have. This is another way that you can start to think about lifetime value or unit costs. I have predictability here, and therefore I shouldn't wait until everything is perfect to build a business. I could build a business, way back here. But unlike Bento, I just need to be able to last long enough. If I can't last long enough, then it was a waste. So I jumped around a bit in this talk, but I hope that this was informative, that this was, something to, give you some things to think about. I talk about all different examples in this book called Growth Units. This is what I use to teach this topic, now at USC. But I am happy to answer questions that anybody might have, and we can hang around and talk about maybe what you've observed, or if you're working on, a business, we can talk about that too.
Yeah, all right. Thank you so much. Thank you so much for your talk. Now we're going to move into our Q&A session. And before that, I actually have a few questions prepared. So I'm going to go ahead and ask them. So the first one is, as you said, you teach growth hacking at USC, and I was wondering, this is a relatively, unknown topic, and how did you decide to, why did you decide to specifically teach this topic in entrepreneurship?
So when I was hired, I was really looking at the selection of courses that were available. And I was talking to a lot of students. Like, the first couple of months after I was hired, I talked to around 100 different students, just asking, what's going well for you here? What do you like? What are the classes you like? Or what are the other resources or clubs, things like that? Because I didn't go to USC. I wanted to learn more about the place. And at the same time, I also had all these startups that I was working with, and a very wide range, everything from 18-year-olds in their dorm rooms to people with decades of experience who were alumni and were now coming back for the guidance. And one of the things that everyone struggled with or seemed to be able to benefit from was, how do I get distribution? Like, how do I figure out, now that I've built something that I think is pretty good, how do I actually figure out how to get it to the right customers? And there wasn't a lot of attention to that question. And as a result, I put together a proposal for teaching this class. It was approved, and I ended up doing that. I teach the class in a very I'll say non classroom style. So the bulk of the work for students in the class every semester is that they work with a startup on these topics, like understanding the sources of their growth and how they could improve that. So I've had people in the past do everything from, run paid social media campaigns, to identify influencers, to do A/B tests, to test like open rate and try to improve open rate in email campaigns, try to improve a click-through rate in a campaign, but also, and importantly, just like really understanding like what is the cost structure here? Why are you charging this instead of some other price? Why is retention the way it is? Why do people leave? And these questions sound very simple, but once you start digging into them, there's a lot to uncover. And the businesses that succeed actually end up doing this pretty well.
Yeah, super cool how you got to sort of start your own course at USC. And you mentioned that you have obviously your own startups, and I was wondering like, why specifically did you decide to start your first accelerator in Hong Kong? And like, what was it like starting an entirely new country, and did you face any like, cultural barriers?
So that experience for me, so I was in New York at the time, and I knew that I liked, so I had a startup, and I had a lot of friends who were starting startups. I knew that I liked, working with founders. I was looking into starting a startup accelerator in New York City. At the time, there already were 10 accelerators. This is 2011. And I didn't think it made sense to try to start the 11th one. So I was looking for a new market to go to. And for me, Hong Kong was not a random location. It was a place that I had actually worked for a little while. I was, conversant in Cantonese. So like, I wasn't just like completely showing up, with no knowledge. There again, like I took a similar approach to what I described, in the university, in that I took a scouting trip over where I talked to as many people as I could. I tried to understand what the ecosystem was like. Entirely different ecosystem from New York or from the Bay Area, or wealthy city, a big city, but the money was not going into early stage tech. Talent was not going there. And so it was a combination of identifying that I think this location is at a tipping point. It's been held back a little bit. There were also multiple other groups that had made a little noise about starting an accelerator in Hong Kong, and they'd all failed. And I realized it was because they did not take the time to understand the local market. So I thought, okay, I have identified something that other people have not identified yet. The time to do this is now. If I wait, it's going to be too late. And I needed to raise money to support that. I could not invest in a portfolio of companies without having a small fund there. So in order to demonstrate that there was some potential, I did at first a boot camp in Hong Kong, where I basically welcomed companies in for a fee to do this program. And I showed, hey, they're better coming out of it than they were coming in. And it actually became, became popular. I had people coming in internationally even to do this. And from that was able to demonstrate, okay, this makes sense. This location works. I know what I'm doing, in this case. And then was able to find an investor who put the money in for the fund. And then we then used that, and, we invested in 12 companies, that first year. So, yeah, for me, it was like all of those factors, wanting to seek a new market, but also one that made sense for me personally, and then having a process to do that.
Yeah, I think that's really cool how you know how to speak Mandarin and Cantonese, because I know a lot of us here do too. And moving on to our next question. So I know you wrote Startup Sacrilege for the Underdog Entrepreneurship, another book, which was based on your time working internationally. Could you maybe give like a short summary of what that book is about?
Oh, sure. So I have a real interest in startup ecosystems that are like outside of the big hubs. So I spent a good amount of time talking to people around the world about their experience. So this is everything from, like people who are in, Kenya, New Zealand, remote parts of the US, even, about how they made their company possible or successful without having a lot of what I think we take for granted in the Bay Area, in Los Angeles. So that book was all about, that. Like, what are the examples of people, making it work out, how you might build your business differently if you are a little resource constrained. Yeah, and this, that book was 2014. So a very different funding situation than today. But I think a lot of the growth in funding, it's still not, really going to these, small, ecosystems, so much. So I think there's still a lot to learn in the, the experience of how do you bootstrap or how do you build for a local or regional problem that maybe is not applicable to, say a US audience that would not be attractive to, say, a US based investor. And yeah, that, that book grew out of, those conversations that I had.
All right, thank you so much. We have a question submitted by someone. Was there ever a startup that you thought about investing in but didn't and later regretted? Or was there one where you were glad that you didn't invest?
This is a great question, and I should have like these examples at the tip of my tongue. I'll give you one it's a little bit of a cheat because I didn't invest in them, but they were a USC company that had applied to the incubator I was running at USC. So when I was first hired, brand new program, nobody really knew about the program. And I had an applicant in, I think, the second call for applications that I had. So I had been there like, 6 months, maybe. I had an applicant in the, that second call for applications that I was considering very seriously. And I was capping the batch size at the time at 8. I've increased it a little bit since then. But it was between, they were a health tech company. It was between them and another health tech company. And I declined this one company, that had applied. A week after I declined, they wrote back to me and said, just want to let you know, no worries on not admitting us. By the way, we just raised $1 million. And this was, again, like, 2015. So $1 million at that time was, I don't know, equivalent to, I don't know, 5 million today or something like that. And that would have been, in that incubator, that would have been like, ooh, this is the first, company raising something significant. So I felt a little bad for a while. The good side, though, was the other health tech company that I did bring in ended up being the first acquisition that we had from that incubator. And then later, I had that other health tech company that I had declined initially reapply, and I brought them in. And now they are also like one of the big, successes that we've had in that program. So it's a little bit of a cheat on, I guess, answering your question, but I'm just reminded of that. It's very difficult to be able to, predict the future, right? What I showed you a little earlier today was companies with some example of how they might do that. You can only, however, get to that point after you've had a bit of history. So when you're looking at super early stage startups and there isn't much of a history there, you're really thinking of, well, do I like this team? How big could this market be in theory? If everything goes right, what is plausible? What could happen? But that it's highly uncertain, and that's why, investing is a game of outliers. You don't expect most of the investments to do all that much, but you have a small number that more than make up for all of the losses that you've incurred.
All right, yeah, moving on to our next question submitted by someone. How have you used the concepts of CAC and LTV in your own startups, and how effective are they?
In my own startup years ago, I didn't understand these deeply enough. And so we had a startup that initially was consumer focused, and we really did not have a business model. We had some ideas, but we were not going in to this with a real business model. And it wasn't until we turned it into an enterprise service, like serving businesses, that things started to improve for us. And that came through customers contacting us, out of the blue, and like telling us, no, we want to use what you have already built, but we want it, white labeled for us in-house. And we ended up selling, licenses to our technology. But yeah, I'd say like in the beginning, to be honest, I was not thinking of these things. I was thinking much more about, building a cool product. I was wasting time on things that were not essential. And it was only after I understood like, oh, okay, there's this other group of people who want to pay for this now. Maybe we should pay attention to that. And they also stay with us for a long time, or at least it's what seems to be happening. They don't want to, rip our tech out and use something else, very often. So my own experience was like learning these things the hard way. I'll have to answer like the question that you asked about like how well does this work, by saying like, if you can actually figure out what the trigger points are, then it can work very well. The problem is if you're super early stage, you just don't have the data yet. You don't have customers, or you don't have enough customers, or you have not yet tried variations of pricing or variations of the product. So you're not at the stage where you have true predictability. The last example that I was giving of the data storage companies, or the other example of like Shopify, that's where you start to see you do have some predictability. And that's where, LTV and CAC, there are just like entire teams of people just working on trying to optimize, different elements of, when the payback period is, or what should pricing be to, still maintain, retention, but, earn a bit more. Where can we, trim some of the costs? Super early stage, you need to make more guesses that are, I think, thematically correct, but it's you're not going to be able to go as fine-grained as like some of the examples I showed at the end.
Mm-hmm. All right, I think we're gonna time. Maybe we have time for one more question. What do you think right now is the most overrated or underrated company, overvalued or undervalued?
I don't know. I never like saying this either. It might be easy to say Clubhouse, just with uncertainty about what's going to happen in the future with that business. Might be easy to say something like, that people had higher hopes for, like Snowflake. But I don't know. To be honest, I tend to not be as interested in like the companies that are getting a lot of the attention, and I'm more interested in like some of the the smaller examples where I think they are smaller because the attention hasn't focused in that area yet, or they're smaller because they're just quietly building product rather than seeking attention. But I don't know. Those are a couple to toss out.
Mm-hmm. All right. Yeah, looking at the time, we've reached 6 now, and I want to say thank you so much, Professor Landon, for staying the entire 1 hour. like answer questions. And I think I can speak for everyone when we learn something new about like costs and like how businesses, what factors businesses should consider. And hopefully this presentation was helpful to everybody. Yeah, thank you so much for being here today.
Happy to. Yeah. Good luck, everybody. Sounds like a great group. So good luck as you're all going on to college, wherever you end up going.